So today we're going to deep dive into all the tax strategies that you can utilize as a passive investor to shelter your rental income, to shelter your capital gains from taxes, how you can potentially shelter other passive income from taxes, and in some unique situations, also shelter active income from taxes as a passive investor, right? We'll also be talking about the beauty of a lazy 1031. So we'll deep dive into what that is. And I will also at the end go over pitfalls, things that I think as a passive investor you should be looking out for. Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. Tax strategies for the passive investor. This has been something I'm super passionate about. I've heard many physicians in our community come in and say that because they're passive investors, they're really not able to tap into the tax efficiencies afforded to real estate investors. But that's not really true. That's actually very far away from the truth. I know physicians in our community who are sheltering 6 figures of income from taxes, even as passive investors, while they're working full-time in medicine. So again, just to highlight that, you don't have to be self-managing multiple short-term rentals, spending over 750 hours a year in real estate, finding properties, running numbers, managing rehabs and tenants, or you don't have to work part-time in medicine before you can start tapping into the tax efficiencies afforded to real estate investors. And I think educating yourself is always the first step. Again, like I said, I am not a tax consultant, not a CPA, I'm a radiologist. So you should consult your tax professional before you make decisions that are unique to your personal situation. When we are informed, when we are educated, and we can actually present situations to our professionals, when we understand our current portfolios, our tax situation, then we're able to make better decisions along with the professionals who are helping us, right? And in my case, I've had multiple instances where I was working with tax consultants. Sometimes they weren't real estate savvy, so they missed tens of thousands of dollars of deductions because of that. Sometimes they were real estate savvy CPAs, but again, I didn't do my own due diligence in terms of understanding what I could do and how I could strategize. And so education is always going to be key, even if you're working with a really savvy real estate specific CPA. And I hope that at the end of this episode, you're able to understand your situation better and also strategize and figure out the pieces of the puzzle that you have to play with and really work with it. We're going to talk about all the different ways you can shelter your income, your gains from taxes as a passive investor. And remember, when you are seeing returns that are provided for any particular syndication deal, right? Passive investment opportunity. Remember that the tax savings is not added to that, right? So if you're strategizing around tax savings, that is boosting your returns. That's the first thing to remember. And the other thing is that the most important thing is that you never let the tax tail wag the dog. So for any deal, if you're getting, if you're comparing two deals and one has more bonus depreciation, that should not be the guiding factor, right? It should always be the merit of the deal. Does it fit your buy box? Is it a conservative deal? Does it make sense on its own merits, right? That's the other important thing. Okay, now that being said, let's deep dive into how, as a passive investor, you are able to strategize around tax savings, right? And I've broken this down. I'm doing my best to do the subject justice, but we're going to talk about, the 5 different ways you can shelter your income, equity from and your cash flow from taxes, capital gains, all of those things, right? We'll talk about that first, and then we'll talk about pitfalls that you have to ensure when you're strategizing, little things that you have to remember to make sure you can optimize better and you're not losing out on maximizing your tax benefits. Okay, first thing, rental cash flow. I'm going to stick to passive investments, right? And then predominantly syndication investing, right? It also holds true for other passive real estate that you may own, right? Rental cash flow is the number one thing that's going to hit your bank account, right? When you enter a syndication deal, when you enter passive investments in real estate. That cash flow, if strategized correctly, can be sheltered completely from taxes. So you can essentially get tax-free cash flow. How does that happen? This happens because of depreciation. Depreciation is paper losses that you are allowed to take legally on the building basis. So when you purchase a property, there's land, there's building. The building basis can be depreciated over time. Now, usually straight line depreciation exists, and that's 27 and a half or 39 years, depending on the kind of property you have. But we are in this beautiful space where we actually are able to bonus depreciate, which means that in year one, you may be able to get a significant portion of that depreciation without having to wait to take it over time. How does that help us? Let's take an example. Now, usually, if I make $10,000 of income, and I live in California, so I'm paying marginal taxes. My marginal tax bracket, comes into play. So I'm paying about 40%, 39% in federal taxes, another 13% in state taxes. Right now, if it's passive income, I'm not paying self-employment taxes, so that's a benefit. But I'm still at that 50% marginal tax bracket, right? So if I had an additional 100,000 of income, earned income, right? If I work as a radiologist and I get 100,000 in bonus, or I've exceeded my RBU requirements and I'm making that 100,000 additional income, I basically get to keep, if I'm lucky, 50,000 in my pocket, right? And I'm paying the rest in taxes. Now, if I made $100,000 of passive income from rentals, including syndications, right? Then when I'm able to tap into depreciation, right, I'm able to essentially not have to pay taxes on any of that income. So if I made $100,000 of income, and it's all passive and I have depreciation to offset that, then I'm not paying any taxes on that. Another way of looking at it is I have to make $100,000 of earned income to be able to keep $50K, as opposed to $50,000 of passive income, right? If I have $50,000 of passive income, I'm not paying taxes on it. It's the equivalent of making $100,000 of earned income. Now, what happens when I get to keep that money in my pocket? This is where the time value of money comes into play. If I have $50,000 that I can keep in my pocket today and not have to pay in taxes, then I'm reinvesting that money. This is what time value of money means, right? I'm able to take that money and reinvest it and double it in 5 years, right? So that's the magic. People talk about the magic of compound interest. And honestly, when you're in the real estate space, leverage and the ability to be tax efficient, that clearly trumps compound interest, which is touted as the eighth wonder of the world, right? So there's that time value of money that's happening. So hopefully you can understand how impactful that is. Now, bonus depreciation is beginning to phase out. So till 2022, we had 100% bonus depreciation, right? So September 2017 to December 2022. Last year, we had 80% bonus depreciation. This year, we still have 60% bonus depreciation. How does that translate with an example? If I invest in a syndication, I'm going to give you the example of the syndication that we currently have open in the Austin, San Antonio corridor, New Braunfels. It's generationalwealthmd.com/Austin in lowercase for those of you who haven't checked it out. If you invest $100,000 in this particular deal, you're able to get $50,000 to $60,000 in passive losses in year one because of bonus depreciation. So let's just take $60,000 as an example. Now, the actual numbers happen when after acquisition and after actual cost segregation is done. This is an estimate. But say you put in $100,000 as a passive investor, right? That's what you're wiring in. In year one, you get up to $60,000 in passive losses, right? Now, these are paper losses. You are actually, if you're a Class A investor and you're making 10%, the first year you're going to make about $10,000, right? But you still, on paper, you have the $60,000 in passive losses that is sitting as a loss. And that is because of depreciation. And it allows you to shelter the cash flow that you have from that investments if you're a Class A investor, year one, you have $10,000, year two, $10,000 of passive income, right? You have $60,000 of losses that allows you to shelter that income from taxes, which means now it hits your bank account, but you're not paying taxes on it, right? That's the power. Now, the Villas at Sundance, which is this deal that we have, it actually is a Class A asset, so it has higher cash flow, right? And because of the way it's structured, it also has higher depreciation than we've seen in most of our recent deals, right? That, along with the fact that we have 60% bonus depreciation in 2024, gives us the ability to really tap into these higher losses before bonus depreciation goes down to 40% next year and then 20% the following year, and then it completely phases out, right? So for those of you considering investing in syndications, remember that there is a phasing out that happens, and we're actually at a good spot right now where we have 60% bonus depreciation. Now, what happens to these losses if you don't use them in the first year? So if you're getting 10,000 in income and you have 60,000 in losses, what happens to the losses you aren't able to use? They get carried forward to following years. So if you're in the deal for 5 years and you made $50,000 in passive income and you had $60,000 in losses, then you're not paying taxes on any of that income. You're keeping it in your pocket. And like I said, time value of money, you're reinvesting it and you're growing it, right, without paying taxes. Now, savvy investors out there, you're going to be asking me, what about depreciation recapture? We will talk about it when we talk about pitfalls. Okay, so stay with me. The second part of this, so we get tax-free cash flow from our syndication opportunities as a passive investor. The second part of this is going to be capital gains, right? Most syndications are held for over a year, unlike a flip where you're selling it within a year. That's the business plan. Therefore, you're taxed. You have short-term capital gains, and you're taxed at your marginal income tax bracket, which for someone like me is going to be 50%. And for most of you, that's where you're going to land, right? Now, in syndications, right, you are staying in the deal for 3 to 7 years, ideally. And that means that you're paying long-term capital gains. Long-term capital gains is taxed at 20%. And so it's a progressive tax. And at the highest amount, it's in the low 20%, right? So let's just say 20%. That is significantly lower than a 50% marginal income tax bracket, right? So you're already taxed at a lower amount. The second part of the equation is you have the ability to defer having to pay those capital gains, just as you would if you had an investment property that you owned directly, right? And again, this, many of you may know this, it's called a 1031 exchange. Now, there are certain criteria that needs to be met. With syndication investing for passive investors, the entire syndication LLC needs to 1031 into the new deal. And this is a question to ask your sponsors. Is that written in the language of the PPM? Do they have the ability to do a 1031? And is that part of the game plan? It's not guaranteed because a few things need to fall into place. But oftentimes, sophisticated sponsors are trying to do this to give you the ability as a passive investor to defer having to pay both bonus depreciation recapture and long-term capital gains so that your capital is growing tax-free and you're not getting depleted. Although long-term capital gains is a lower, close to 20% rate, you still want to be able to defer having to pay those taxes if you can, so your capital can grow tax-free. What are your other options, right? This is where I think it's important to get creative. For many of you, when you have one-on-one conversations with me, this is a question I ask, right? I'm always asking, guys, do you have other real estate investments? Do you have other passive investments? Do you have other passive losses from other syndications? And the reason I ask this is because as a real estate investor, you are in a position to do what we call a grouping election. Now, what happens with a grouping election? When you do a grouping election, and again, this is a conversation for you to have with your CPA. And remember, different CPAs have different thresholds and comfort levels, and they interpret the law differently. And so if you are trying to vet different CPAs, talk to at least two, so you have an idea of what their thresholds are and that they're comfortable with what your strategic plans are. But the grouping election allows you to group all of your passive real estate investments as a single entity, and therefore you're then able to use passive losses from other syndications or other rental properties that you may own to offset your long-term capital gains, right? And the critical thing to remember over here is that if you have a long-term rental that you acquired after September 2017, right, when bonus depreciation was actually, this was with the Tax Cut and Jobs Act, any passive rental real estate acquired after September 2017, if you may be able to go back and 100% bonus depreciate that property in, say, 2026, if you're exiting a syndication deal at that time, and you will still be able to do 100% bonus depreciation, right? So when you have other real estate, and this may be syndications where you have passive losses from other syndications, you have the ability, and you're exiting a syndication, you have the ability to go back and bonus depreciate an asset you've acquired in previous years, or use syndication losses that you've accrued in previous years to offset your capital gains, right? So remember, you can plug and play over there. That's something I want you to be intentional about as you're building your real estate portfolios, and that's called a grouping election. Now, something similar is a lazy 1031 exchange. So what is that? A 1031 exchange, like I said, is a little restrictive, right? You have certain criteria you need to meet. You have certain timeframes within which you need to identify the next property and then acquire it, right? And that can be a little challenging sometimes. And so something that a lot of real estate investors have done in the last it's 7 years now, since 2017, is called a lazy 1031. A lazy 1031 is very simple. Suppose I'm exiting a deal today and I have $100,000 in gains, right? And let's combine gains and depreciation recapture for this example. If I were to take all my gains from that asset and invest in another asset or a syndication, right? If I were to take that and invest in a syndication where I am getting, because of my investment in it, and I can take the initial equity and the gains, or I can just take the gains, whatever makes sense for me, right? And if I'm investing that into this new deal, it could be a syndication deal, a passive investment, and I'm getting $100,000 in losses because of my investment, I can use that to offset the capital gains and depreciation recapture from the deal that I've exited from, right? That could be something in my personal portfolio. It could be another syndication deal. As long as that happens within the same calendar year, which gives you more bandwidth, and you're now not restricted by the 45-day limit for identifying something or the 6-month limit for making those transfers, right? So now you have with the lazy 1031, you have more bandwidth to play around with different acquisitions, right? And again, this gives you the ability to grow your wealth tax-free. So you're in a sense kicking that tax payment down the road, which is very beneficial. Okay, so that's in terms of capital gains. So let's move on to the next part. When you are investing in syndication as a passive investor, you are building equity over time. As we increase the net operating income, right? As we increase the income that the property throws out, you are increasing your equity in the property. And so oftentimes, we don't underwrite for a refinance. There are some unique situations. If some of you may be in the crossings at McDonough with us, where we did underwrite for a refinance in year 3 or 4, that's because of the way the debt was structured in that particular deal. But if you are in a deal where, and sometimes in our deals, even though we predict an exit in 2 or 3 years, this is true for the deal we are in Mesa, we may go ahead and do a refinance so that we can sell at a more opportunistic time down the road, right? Whenever a refinance is done, if it is a cash out refinance and you're able to tap into the equity in the deal, then because it is a cash out refinance, that is a tax-free event. Right? And so that's something to remember. You have the ability, even as a passive investor, to tap into your equity. And when you are returned that equity, that is a tax-free event with a cash out refinance. Now, the reason we don't typically underwrite for that is because if you were to do a cash out refinance and then hold on to the asset for longer, you still have equity trapped in that deal, even with a cash out refinance. And your return on equity starts dropping because the first 2 to 3 years is when you see the highest return on equity because you're actually going into and doing a value add proposition. The longer you hold a deal, the returns get muted. And for most passive investors, it then doesn't fit their buy box, which is why we enter deals that we exit within 3 to 7 years. But that being said, if there is a situation where a cash out refinance is done, even as a passive investor, that is a tax-free event for you. And that's how we tap into the equity in some situations. Okay, now, how else can you strategize around the bonus depreciation that you're getting as a passive investor? There is this term, if you've not heard this before, I don't think I've actually talked about it a lot, except within our coaching program, the Creating Generational Freedom coaching program. It's called Your Pigs Need Pals, okay? It's a simple way of remembering that pigs, which are passive income generators, right, can be matched up with your pals, which are your passive activity losses, for you to suddenly boost your returns from real estate, even as a passive investor. So let me explain that. What are PICs? What are passive income generators? Now, for some of you, they may be short-term rentals. Now, we've had coaching clients within the coaching program. They've spoken during the summit. In year 1, within the program, they acquired 2 luxury short-term rentals. They were able to and while working full-time and raising 3 young kids, right? They were able to shelter $800,000 of clinical income from taxes because of that, because they were able to self-manage their short-term rentals. In year two, if they decide to go passive, right? If they decide to, in year two, it's harder to hit material participation because you have cleaners who are spending more time on the property than you are, right? And so in year two, if they are passive in that investment, that short-term rental is still going to throw out significant cash flow, right? And especially because they did bonus depreciation in year one, they're not going to have enough bonus depreciation to offset the higher cash flow that you get from, say, short-term rentals or midterm rentals. And now they have passive income that they would be paying 50% taxes on if they don't have PALs, which are passive activity losses, which is where syndications come into play. And so the couple and many other students within the coaching program who invest actively in short-term rentals in year one get those losses in year two. If those short-term rentals don't meet criteria for material participation and they're throwing out passive income, that's true for midterm rentals. It is also true for long-term rentals that you don't have a mortgage on, right? You can go and check with your CPA. If you have a mortgage on it, and if you've put 25% down, you likely don't have passive losses because depreciation is offsetting your cash flow. But if you have unleveraged long-term rentals, midterm rentals, or short-term rentals in year two, you will have passive income and you need PALs, which are your passive activity losses. And this is where your syndication investments or other passive investments come into play, where you can tap into bonus depreciation. And you now have this strategy where you're throwing out so much more passive income, but you're not paying taxes on them because you have PALs to pair your pigs with, okay? And so as funny as that may seem, it's a good point to keep at the back of your mind. So whenever you have passive activity losses, if you have 60,000 in losses from your syndication investment this year, and you are able to strategize around that and increase your passive income, you now are significantly boosting your returns from your overall portfolio because you're tapping into those tax efficiencies right away, and it gives you the time value of money. You're going to keep more money in your pockets today, and then you reinvest it and you're growing tax-free, right? So that's super, super powerful. And I hope I did justice to that explanation, but it is a very powerful strategy that a lot of you should be tapping into. And this could also include, remember, passive income generators can be short-term rentals in year two. They can be midterm rentals. They can be unleveraged long-term rentals, but they could also be, for a lot of physicians, they have ownership interest in a business that you're not materially participating in. So you could have income from surgical centers, endoscopy centers hitting you as passive income, right? Again, a good idea is to go and check and take a look at your tax statements and see how that's hitting you. But I know a lot of physicians have passive income from other entities that they are not materially participating in. And this is a great strategy to start boosting your returns by ensuring that you're not paying taxes on all of that passive income, right? So pair your pigs with your PALs. And if you have PALs, think about where you can, what pigs you can introduce into your portfolio. And like I said, again, if you are able to tap into those tax savings right away, that gives you time value of money. You're boosting your returns right now, and you're growing your wealth tax-free. Again, remember, bonus depreciation is phasing out, so we will not see the same losses we're seeing right now with syndication opportunities over time. They will diminish. When bonus depreciation phases out, we will be using something called accelerated depreciation. It's not going to be as impactful as what we have right now. So if you're considering opportunities and you want to go and vet some great opportunities, definitely check out the Villas at Sundance. Hey guys, I am super excited to present our next opportunity. After months of due diligence, we have a new deal in the Austin-San Antonio hypergrowth corridor. And the best part is that every GW investor gets reserve class preferred returns in this deal. The Villas at Sundance is a 252-unit Class A Core Plus asset built in 2012 in New Braunfels, which is the third fastest growing city in the country, with a population growth of nearly 33% in 2023 alone, with many new major employers, entertainment, and the economic impact from tourism in the area is about $700 million. This is the submarket where I've been underwriting deals for the last few years for my personal portfolio. It has the highest occupancy in the Austin-San Antonio MSA, and since this is a Core Plus asset, it has high cash flow day one. The debt terms are conservative. That, coupled with the expected population growth, makes this a lower risk opportunity for the current economic cycle. And to make things sweeter, we're acquiring it at a substantial discount compared to the cost to build new in the market. And again, all GW investors get reserve class returns on this deal, which is huge. So if you want to learn more and catch the investor webinar, go on to generationalwealthmd.com/Austin in lowercase. remember, when you have passive losses today, you don't lose them if you don't use them this year. They get carried forward and you can use them in the future. And that's what I want you to remember. Now, can I use syndication losses against my active income? This is a very common question that I get to hear. There are very unique situations in which you may be able to do that. And that is if you or your spouse qualify as real estate professionals, then you're able to do the grouping election. Your passive portfolio can be grouped with your, with your direct ownership portfolio if you meet criteria for real estate professional status or your spouse meets criteria. Some of you may have a spouse who is an agent, who is a contractor maybe, or is in a real estate trade that is accepted to qualify for that status. And a lot of our students within the coaching program do this also because they may qualify for as a real estate professional. And then when they start investing in syndications, they're able to group everything and use the losses, passive losses. Their passive losses now become active losses that can be used against their active income, including W-2 income, right? So if you want to get on the wait list for the coaching program, that's generationalwealthmd.com/waitlist in lowercase. Remember, as always, even if you believe you do qualify as a real estate professional, please talk to your CPA and make sure that they take a look at your overall situation and the grouping election makes sense for you. Okay, we're done with all the five different ways you can save your income from taxes. So tax strategizing. We talked about rental cash flow. We talked about long-term capital gains. We talked about equity that you're building in the syndication opportunity or passive investments. We talked about other passive income that you have where you are able to shelter that, and how you may, in unique situations, be able to shelter active income from taxes. Now, what are the pitfalls? What are the things I want you to keep an eye out for? If you are exiting a syndication investment with gains, say this year, right? And you're considering a 1031. Remember, like I said, if you're in a syndication, the entire syndication needs to 1031, but you may not need to participate, right? So this is where I want you to talk to your tax consultant or go over your tax return and see if you have other passive losses that you may be able to use to offset your capital gains, right? And your depreciation recapture, so that you do not need to go ahead and do a 1031. Unless you want to, then that's absolutely fine. You can use those passive losses later, but it's always a good idea to know what your passive losses are. Or if you have properties that you acquired after September 2017 in your rental portfolio, then know that you can go ahead and do 100% bonus depreciation on those properties if they were acquired before 2022 December. And then if they were acquired in 2023, you can still do 80% bonus depreciation, and you can do that in a future year, right? And you still get to your bonus depreciation is still locked in at the year that you acquired the property. So a property acquired in 2023, you can still get 80% bonus depreciation. So that becomes really powerful. So check to see if you really need to do the 1031 or if you can get away without doing it. I'm going to go now talk about depreciation recapture, right? So a lot of you have questions, and I hear this all the time. But Param, I get all of this depreciation. It offsets all of my, taxes on distributions that I have, but I will have to pay depreciation recapture on the back end. And the answer to that, and this is where I want you to think strategically, like an investor, right? The answer to that is that you don't have to pay depreciation recapture. There's so many ways to defer paying that, right? And to strategize around that legally. Okay. So the first thing is if you have prior losses, other passive losses that you have from other syndications you're entering into, or from other acquisitions, direct ownership real estate that you have, you can use those prior losses to offset depreciation recapture. You can 1031, the entire syndication can 1031 into another asset to offset, and then you're deferring having to pay depreciation recapture. You can do a lazy 1031. So you may exit a deal and you may be able to enter another deal. And again, we don't know what tax law is going to look like a few years down the line. Bonus depreciation may be reinstated, right? And we will still have accelerated depreciation. So you may be able to still strategize around that and use a lazy 1031. And finally, even if for some weird reason you aren't able to 1031, right? You don't have that option. You don't have any losses from other syndications, right? You didn't get into multiple syndications when you could still bonus depreciate quite a bit. You don't have prior losses. When depreciation recapture happens, that happens, say, 3 to 5 years down the line when you're exiting, right? So you've still had the time value of money. You still got the equivalent of an interest-free loan and your capital was able to grow. I mean, with the way interest rates are, anyone would get an interest-free loan, right? So you've got a loan, you don't have to pay for it, and you're paying taxes on the back end. In that time, your capital has grown, right? So you've had capital growth happen, and you're deferring having to pay those taxes. So a savvy investor will always defer taxes when possible, because even if you are recapturing those taxes, and I talked about many ways where you can go in and you don't really even have to recapture the taxes, you can kick that bucket down the road. But even if you don't do it for whatever reason, you still have those 5 years where you're able to grow your capital and you didn't have to pay taxes, right? So you should take advantage of that. Now, in the pitfall section, I also want to talk about step up in basis, right? So when your heirs inherit your real estate portfolio, capital gains and depreciation recapture is wiped out, okay? And that holds true for syndications also. Again, talk to your CPA, but that does hold true for syndication investments also. Now, there are a few situations where it won't really hold true. When you invest through an IRA using tax-deferred money, then step-up in basis doesn't apply. When it's a joint investment and one of you passes away before the other, then there is a partial step-up in basis that happens. So those are things to think about. But you do still get to benefit from step-up in basis when your heirs inherit the investment. Capital gains and depreciation recapture is usually wiped out. So that's something to talk to your operators and to talk to your CPA about, and anyone who assists you with estate planning. Now, like I said, again, the final pitfall that I want to mention is remembering that bonus depreciation is phasing out. So if you want to take advantage of it, we will have transaction volumes are really low this year, right? And so we're going to have very few opportunities for you to really tap into it. So if you are looking to tap into bonus depreciation before it starts phasing out, then the villas at Sundance is an excellent opportunity. For every 100K investment, you are getting 50 to 60,000 in losses. Now that's higher than what we've seen this year for most other investments. So go check it out, generationalwealthmd.com/Austin in lowercase. But again, remember, the goal of all of this, whenever we save on taxes, is that your tax savings gives you the ability to grow your capital and defer taxes down the road. So you're growing a larger amount of money. It gets you to, when you take the larger bucket where you haven't paid taxes, right? You're not eroding your capital because of taxes, and it keeps growing and you're getting distributions based on that entire capital. That's getting you to financial freedom faster. And that's the goal, right? And so remember, you can tap into the tax efficiencies of real estate, even as a passive investor. Being able to do that enhances your returns further. These returns, the tax savings, are not factored into the overall return projections that we give you for investors, right? So reserve investors get 18 to 22% average annualized returns on projected 18 to 22% average annualized return on villas at Sundance. But that's not factoring in. That's not even factoring in all the potential tax savings you're having, right? So that doesn't take that into account. Like always, don't let the tax tail wag the dog. The deals should stand on their own merit. The villas at Sundance, which is in the Austin-San Antonio hypergrowth corridor, for all GW investors, we are getting higher preferred returns. So that's amazing. What an investor had access to only if they brought in about $500,000 to the table. Every investor in GW has access to those higher returns. That is super powerful. It's a deal where you get cash flow day one, which is kind of hard to find in the current environment. So every month, as a Class A investor, you get prorated 10% that hit your bank account every month. For Class B investors, it's between 4 to 5% in year one, and that keeps going up. And that hits your bank account every month. So you're getting cash flow day one, which is kind of hard to see in this environment. It's a Class A asset, which is relatively the 2012 build, inherently lower risk with conservative debt on it. But the fact that it's in that hypergrowth corridor, and that because of where we are in the market cycle, because we're at the bottom of the cycle and we're projected to go upwards from here, I think it's a very special opportunity to go check it out. generationalwealthmd.com/Austin. Like I said, every deal has to stand on its own merit. But when you tap into these tax savings, tax strategies as a passive investor, you're enhancing your returns further.